Hey everyone, welcome back to Corporate Decoder, the place where we spill the tea on big companies' financial secrets. Get ready because Wolverine Worldwide is serving up a quarter that is a wild ride of ups and downs, and we're diving deep to see what it all means. So, the latest report from Wolverine Worldwide Incorporated is out. And it paints a picture of a company navigating a changing market with a mix of solid wins and some areas that need a closer look. We're going to break down their numbers, their risks, and what this all might mean for their future. Alright, let's get straight to the numbers that really matter. This is the quarterly report for the period ending the 27th of September 2025, and it gives us a snapshot of how Wolverine Worldwide Incorporated is performing. First up, revenue for the third quarter of 2025, they pulled in an impressive $470.3 million. That is a nice jump of nearly 7% compared to the same time last year. For the year to date, it is even better, with revenue climbing over 7.7% to reach a whopping $1,356.8 million. This tells us that despite some challenges, their core business of selling footwear and apparel is holding strong, and in many areas growing. Looking at the different parts of their business, the Active Group is really shining. Their revenue shot up by over 10% in the third quarter, thanks in a big way to brands like Saucony and Merrell. For the year so far, the Active Group has seen an even bigger boost, growing by more than 13%. This suggests that their focus on activewear and athletic footwear is paying off, likely driven by things like new product launches and strong demand in certain regions. Now, on the other hand, the work group, which includes brands like Wolverine and Cat Footwear, saw a slight dip in revenue for the quarter, down almost 3% year. To date, it is also down by over 5%. This indicates that the market for work-focused footwear might be a bit softer, or perhaps competition is heating up in that area. Let's talk about profitability. Their gross margin, which is basically how much money they have left after paying to make their products, actually improved. It was 47.5% this quarter, up from 45.1% last year. This is a really positive sign. It means they are either selling more products at full price, or they've gotten better at controlling the costs associated with making those products. This is good news for the bottom line. However, expenses are going up. Selling, general, and administrative expenses, which covers things like marketing, salaries, and operating costs, increased by nearly $20 million for the quarter. That is about a 7% jump. This increase is driven by a few things, including higher advertising and incentive compensation costs. While it is natural for expenses to rise, especially when revenue is growing, it is something to keep an eye on to make sure it doesn't eat too much into their profits. So, what does all this mean for the company's profit? Net earnings attributable to Wolverine Worldwide Incorporated for the quarter came in at $25.1 million, which is a bit higher than the $23.2 million last year. And for the year to date, it is a much bigger story, with earnings jumping up to a massive $64 million from just $22.1 million in the prior year. This shows a significant improvement in overall profitability, likely due to the strong performance in the Active Group and improved gross margins. Now, let's touch on how they're organized. Wolverine breaks down their business into two main groups: the Active Group we talked about and the Work Group. They also have an other category for things that don't quite fit, and corporate for all those central expenses. This segmentation helps us understand where the growth is coming from and where there might be struggles. For instance, the Active Group is clearly the engine, driving a lot of the positive results right now. Beyond the financials, every company faces risks, and Wolverine is no different. They're dealing with some significant environmental issues, particularly related to historical operations of a tannery. This has led to lawsuits and regulatory actions, including a consent decree with Michigan authorities, while they've settled some class action lawsuits. The legal and environmental costs are substantial, and they have significant reserves set aside for these issues. This is a long-term challenge that requires constant attention and significant financial resources. Let's look at their debt. They have senior notes that are due in 2029, totaling $550 million. They also have a revolving credit facility, which allows them to borrow money as needed. As of September 2025, they had borrowed $130 million under this facility. The good news is they seem to be managing their debt well, and there haven't been any major issues with covenants or performance ratios. Like many global companies, Wolverine is exposed to currency fluctuations. They use financial tools called foreign currency forward exchange contracts to try and manage this risk, especially with their international sales and inventory purchases. This is a standard practice, and the amounts involved here are considerable. showing they're actively trying to protect themselves from currency swings. And it is not just environmental issues. The company is also involved in day-to-day legal matters, like employment disputes and intellectual property issues. While they state these are typical for a business of their size and don't expect them to have a major impact, it is still a reminder that running a large company comes with always being prepared for potential legal challenges. A quick note on leadership: the CEO, Christopher E. Hufnagel, has adopted a trading plan to sell some of his shares. This is often done to diversify holdings or for personal financial planning, and it is usually done under specific rules to avoid insider trading concerns. He is also planning to sell shares tied to restricted stock units that will vest soon. So, taking a big picture look at Wolverine Worldwide Incorporated, they're showing real strength in their active group brands. Revenue is growing and profitability is improving, which is fantastic. They're also doing a good job managing their inventory, and their debt levels seem reasonable. However, the work group needs attention. A decline in revenue and operating profit that could signal a need for a strategic review or new product development to boost sales. And then there are those persistent environmental liabilities and legal matters. While they have reserves in place, these are ongoing costs that could impact future performance. It is a bit like a balancing act: strong growth in one area offsetting challenges in another. Overall, Wolverine is in a decent position with clear bright spots in their active group, but they need to keep a sharp eye on their work group performance and continue to manage those significant environmental and legal responsibilities carefully. The company is clearly dedicated to innovation and adapting to market trends, which is a positive sign for long-term stability. Investing in this company seems like a calculated risk, leaning into the growth of brands like Saucony and Merrell while hoping they can turn around the work segment and manage their legal challenges effectively. Alright, that is our breakdown of Wolverine Worldwide Incorporated's latest financial report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.